The thought of potentially doubling your money in the next 5 to 7 years.
Yeah.
Well, that's
No.
something that grabs pretty much everyone's attention, right?
Absolutely. That kind of efficient growth, it's what we're all kind of aiming for.
Exactly. Well, today we're going to unpack a report called the Warren Buffett Pyramid. Now, it's really important to note this isn't officially endorsed by, the Oracle of Omaha himself,
Right. No official connection.
but it's a really compelling overview of strategies that suggest maybe this kind of return is achievable. Think of this deep dive as your streamlined guide to understanding some really fundamental investment principles.
Yeah, and what's fascinating about this report is its core idea that through a, let's say, disciplined and informed approach to investing, doubling your capital within that 5 to 7 year time frame is, well, a very real possibility. The report really aims to equip you, the listener, with that knowledge. It draws inspiration from Buffett's philosophy, sure, but with a strong emphasis on practical application and, crucially, a long-term perspective.
Exactly. So our mission today is to really dig into this Warren Buffett Pyramid Report. We want to pull out the most crucial strategies, but also, importantly, highlight the key mistakes it warns against.
Good idea. The warnings are just as valuable.
Totally. We want to give you a clear understanding of how you might aim for that potential doubling of your investments while, navigating around some of the more common and, frankly, costly errors. No complex jargon, just actionable insights you can maybe use.
Precisely. And the report does kick off by pointing out some of those major pitfalls that can really undermine your investment ambitions. The first one they highlight is chasing the hottest trends.
Okay, let's really delve into this.
Yeah.
Why is it that jumping on the bandwagon, the latest hyped investment, why can that be such a misstep for those of us looking for solid, sustainable growth?
Well, the report underscores how trends, almost by definition, tend to be short-lived.
Yeah.
And their performance, pretty unpredictable. Often, by the time a particular investment becomes widely publicized as the next big thing, the most significant gains have probably already happened.
Oh. Right.
So you run this considerable risk of buying in at a high point and then watching that trend lose momentum, potentially leading to losses. It's interesting how that fear of missing out, FOMO.
Oh, yeah. FOMO's powerful.
It really is. It can just override our rational investment strategies. Recognizing that emotional trigger is maybe the first step to avoiding this pitfall.
That's a great point about the psychology. It's like hearing about a can't-miss restaurant only after the buzz has died down. You might get a table, but you've missed the peak experience, maybe.
Exactly. And the report contrasts this trend chasing with the importance of focusing on, solid fundamentals.
So what does that look like? Instead of chasing the hype.
A long-term perspective. It's absolutely crucial. The report emphasizes identifying companies or assets that possess strong foundational qualities, a lasting edge over their competitors, a moat, as Buffett would say, and promising prospects for future expansion. It's about recognizing that underlying intrinsic value rather than getting swept up in, fleeting excitement.
So instead of being drawn to the latest shiny object, we should be really analyzing the fundamental strength and, I guess, the future potential of a business. That makes a lot of sense. The report uses a really helpful analogy here, doesn't it?
It does, yeah. It illustrates successful investing as a marathon, not a sprint.
Right.
Which really highlights the need for patience and a disciplined approach. You're not aiming for a quick windfall, but rather steady progress and, importantly, compounding growth over the long term.
Compounding, that's key.
It really is. The beauty of compounding is that it's not linear. The longer you stay invested, the more your returns start generating their own returns. It's like planting a seed that grows exponentially over time. Patience is the water and sunlight, you could say.
Okay, so the key takeaway there is steer clear of those, get-rich-quick schemes and really adopt a long-term mindset.
Got it.
What's the second major mistake the report cautions us against?
Okay, the second critical error the report identifies is neglecting proper research and due diligence. It really highlights the potential dangers of making investment decisions without laying the necessary groundwork first.
Why is putting in that research so essential? I mean, it can sometimes feel like a hurdle, right?
Yeah.
Especially when you're eager to just get your money working for you.
Well, investing without thorough research is really like trying to navigate unfamiliar territory without a map or a compass. You're just exposing yourself to unnecessary risks and increasing the likelihood of potential losses.
Mm-hmm.
The report stresses the vital importance of investigating a company's financial health, looking at key indicators like their revenue streams, their profitability, the quality of their management team,
Right.
and understanding the competitive landscape they operate within, as well as the broader market dynamics. Think of it like buying a used car. You wouldn't just look at the nice paint job, would you? You'd want to check the engine. That's like revenue, how much it costs to run earnings, its reliability, the balance sheet. And if it actually gets you where you need to go, that's cash flow. Fundamental analysis kind of does the same for a company.
So it's not just about recognizing a brand name, it's about truly understanding the underlying business. And the report also touches on the idea of not concentrating all your investments in one place.
Yeah.
Right? Diversification.
Absolutely. Diversification is presented as a cornerstone of risk management. Spreading your investments across a variety of asset classes, including stocks, bonds, and significantly, the report specifically mentions real estate.
We'll come back to that, I'm sure.
Yeah, and also across different industries and geographical regions. It acts as a buffer, helping to protect your overall portfolio from the negative impact if any single investment underperforms.
That makes a lot of sense. It's about building resilience into your portfolio.
Yeah.
The report also raises a red flag about something we see quite a bit of today: unreliable investment advice.
That's right. Very important point. The report wisely advises caution when it comes to investment recommendations from, let's say, unverified sources or individuals making promises of unrealistic returns.
Yeah, the guaranteed returns thing.
Exactly. It underscores the importance of relying on credible, objective sources of information. And look, maybe seeking guidance from qualified financial professionals when you need a deeper understanding of your investment options.
Solid advice. Do your own homework and be very skeptical of anything that sounds too good to be true. Now, the third mistake. This one really resonates with the human side of investing.
It really does. The third significant pitfall the report highlights is letting emotions drive investment decisions. It focuses on how feelings like fear and greed can seriously cloud our judgment and lead to less than optimal choices.
Oh, we can all relate to that, can't we? Seeing market volatility and feeling that pull to just react either by selling everything during a downturn or getting caught up in a wave of enthusiasm and taking on way too much risk.
Exactly. Fear during market declines can tempt you to sell low, effectively locking in losses. And conversely, the allure of quick gains can lead to excessive risk-taking during market booms.
Right.
The report also stresses the importance of patience, noting that a lack of it can lead investors to abandon well-thought-out long-term strategies just to chase short-term, often illusory profits. You know, I've seen even experienced investors panic and sell during a dip, only to really regret it later when things recovered. It's a powerful reminder.
Yeah, absolutely. So how do we try to detach ourselves from this emotional roller coaster? What does the report suggest?
Well, it advocates for cultivating a rational and disciplined approach to investing. This involves developing a well-defined investment plan, one that actually aligns with your financial goals and your tolerance for risk, and then, crucially, sticking to that plan, regardless of short-term market fluctuation.
Sticking to the plan.
Yep. It's about maintaining that long-term perspective we talked about earlier and consciously resisting impulsive, emotionally driven reactions.
So having a plan and sticking to it, even when things get a little turbulent. The report also suggests establishing clear financial goals and regularly reviewing your portfolio based on objective analysis, rather than just, going with your gut feeling at the time.
Precisely. Setting those clear goals acts as a powerful anchor, right? And regularly conducting objective analysis helps you stay on course and make adjustments based on logic and data, not just emotional impulses.
Okay, so those are the three big mistakes to avoid. Chasing fleeting trends, neglecting thorough research, and allowing emotions to dictate your investment moves. Now, the report shifts to a more proactive stance, outlining a three-step strategy for potential growth. Let's dig into step one.
Right. Step one is all about building a solid foundation. The report highlights several essential components here, starting with the absolutely crucial step of setting clear investment goals.
Why has the report put such emphasis on this right at the beginning? It might seem obvious, but how specific do these goals really need to be?
Well, the report stresses that clearly defining your specific financial aspirations, whether it's planning for retirement, funding education, or simply building long-term wealth, it's fundamental for aligning all of your investment decisions that follow.
Okay.
Having these tangible goals provides a clear sense of direction and purpose for your entire strategy.
That makes perfect sense. You need to know your destination before you can chart the most effective route. What's the next key element in building this solid foundation?
Creating a well-diversified portfolio is the next crucial step. As we touched on earlier, this involves strategically allocating your funds across different categories of assets. The report specifically calls out stocks, bonds, mutual funds, and, importantly, real estate.
Real estate again. Okay, that's an interesting emphasis.
Yeah.
Why does the report specifically highlight real estate in this foundational stage?
Yeah, it's notable. The report points out that real estate can offer some unique advantages. Things like the potential for long-term stability, generating consistent cash flow through rental income, and the possibility of significant appreciation and value over time. It essentially provides another layer of diversification beyond just traditional financial instruments.
Okay, so a well-rounded foundation includes not just the usual stocks and bonds, but also seriously considering real estate. Good to keep in mind. What else is essential to build this solid base?
Establishing an emergency fund is deemed absolutely critical.
Ah, yes, the rainy day fund.
Exactly. The report recommends setting aside liquid assets cash. Basically, that can cover roughly 3 to 6 months of your essential living expenses. This acts as a vital financial safety net.
How so?
Well, it prevents you from being forced to prematurely withdraw from your long-term investments during unexpected financial challenges, like losing a job or a medical emergency.
Right, that's like having a financial buffer, specifically designed to protect your longer-term growth plans.
Yeah.
Smart. The report circles back to real estate at this point as well, doesn't it?
Yes, it does. It reiterates considering real estate as a potentially significant avenue for long-term wealth accumulation. It mentions various approaches like direct ownership of rental properties, the potential for property value appreciation over time, certain tax advantages that can come with real estate, and also options like REITs, real estate investment trusts, which are basically companies that own income-producing real estate, and even crowdfunding platforms that give you access to the real estate market, perhaps with less capital upfront.
Okay, so the report really emphasizes the substantial role real estate can play in building a solid financial foundation. What are the final pieces of this initial step?
Understanding your personal risk tolerance is paramount. The report explains how your individual comfort level with potential ups and downs in investment value should significantly influence your strategy. It guides you towards a more aggressive or maybe a more conservative approach.
Makes sense, tailoring it to yourself.
Exactly. And lastly, it stresses the importance of maintaining a balanced perspective, resisting the temptation of chasing those quick, often unsustainable gains, sticking to your long-term plan, but also regularly reviewing and rebalancing your portfolio as your circumstances or the market evolves.
Okay, so a strong foundation involves setting clear goals, diversifying broadly with that specific nod to real estate, having that emergency fund for security, understanding your own risk tolerance, and staying balanced for the long run. That's a pretty comprehensive first step. Now let's move on to step 2, identifying undervalued opportunities. This sounds like where the real detective work comes in.
It certainly does. Step 2 really focuses on developing your ability to conduct thorough research and analysis to uncover investment opportunities that have significant potential for future growth, but might currently be trading below what they're actually worth their intrinsic value. The first key element here is fundamental analysis.
Right. For those of us who might not have a deep finance background, could you maybe break down what fundamental analysis actually entails? What are we looking for?
Sure. The report explains that fundamental analysis is essentially the process of evaluating the true or intrinsic value of an investment by thoroughly examining a company's underlying financial health and performance.
Okay.
This means scrutinizing key financial metrics like its revenue generation, its profitability, its cash flow, and the strength of its balance sheet. It's about gaining a deep understanding of the core financial stability and the long-term earning potential of a business. So it's looking beyond just the current market price to determine what a company is really worth based on its fundamentals.
So it's much more than just looking at the stock ticker or recent news headlines.
Absolutely. It involves really diving into those core financial documents, the income statement, the balance sheet, the cash flow statement, to get a much richer understanding of the company's past and present financial performance, and critically, to make informed projections about its potential for future growth.
Got it. What other aspects are involved in identifying these undervalued opportunities, according to the report?
Well, it highlights the critical importance of researching the specific companies you're considering investing in and the broader industries in which they operate.
Ah, the context.
Exactly. This means looking for businesses that possess sustainable competitive advantages. Things like strong brand recognition, unique intellectual property, maybe a dominant position within their market. You also need to assess the overall growth prospects of the industry itself, any potential barriers that might stop new competitors from entering, and any disruptive forces out there that could significantly alter the landscape.
So it's about understanding not just the individual company, but also its position and potential within the larger market. And I imagine this kind of in-depth research applies to evaluating real estate opportunities as well.
It does indeed. When evaluating potential real estate investments, the report details crucial factors, such as the specific location of the property, location, right. Also, broader real estate market trends in that particular area, the physical condition of the property itself, the level of demand for rentals in that market, and the potential for future appreciation in the property's value.
Okay.
It also emphasizes the necessity of conducting thorough due diligence on aspects like comparable property values, what are the prevailing rental rates, vacancy rates in the area, and any relevant local regulations. And again, considering different avenues for real estate investment to find those potentially undervalued opportunities.
Okay, so a similar deep dive, but looking at a different set of key indicators relevant to property. What's the next approach the report suggests for finding these hidden gems?
The report suggests actively seeking contrarian opportunities.
Contrarian, what does that mean exactly?
It involves looking at investments that might be temporarily out of favor or largely ignored by the majority of market participants. Often, negative market sentiment or maybe some short-term challenges can overshadow the long-term potential of an investment. This can create a window of opportunity to buy at an attractive price before the broader market perhaps recognizes its true underlying value.
So it's about being willing to go against the prevailing opinion sometimes. Zig when others zag.
Precisely. It often requires a degree of independent thinking and the ability to see potential where others might only perceive risks or problems. And finally, within this step of identifying undervalued opportunities, the report underscores the ongoing need to stay well-informed.
That feels like a constant requirement in the dynamic world of investing, doesn't it?
Yeah.
What specific areas should we be focusing on staying informed about?
Well, the report specifically mentions staying up to date on overall market trends. Key economic indicators like inflation or interest rates, important geopolitical developments, and any news specific to the industries you're interested in or invested in.
Right.
Utilizing reputable financial news sources and leveraging credible investment research platforms are essential tools for identifying emerging opportunities and understanding when an asset might be genuinely undervalued.
Okay, so step 2 is all about becoming a discerning researcher. Delving into financial data, understanding industry dynamics, carefully evaluating real estate opportunities, maybe being a bit of a contrarian when the data supports it, and maintaining a constant awareness of market and economic conditions. Now we move on to the final step, practicing discipline and long-term thinking. This feels like it directly addresses one of the critical mistakes we discussed earlier, right? The emotional side.
It absolutely does. Step 3 really centers on the essential mindset and the consistent actions that are required for achieving long-term investment success. The first key principle the report emphasizes here is to stay the course.
That can be easier said than done, especially when the market experiences some turbulence. What's the key to maintaining that steadfast approach?
Well, the report stresses the importance of avoiding impulsive decisions that are driven by either fear or, conversely, excessive optimism. It's about firmly adhering to your well-thought-out investment plan and resisting the urge to react hastily to short-term market fluctuations or fleeting news cycles. It's crucial to remember that investments will naturally experience ups and downs, but a long-term commitment is typically what allows you to fully benefit from that power of compounding returns we mentioned.
So resisting the urge to panic sell during dips and also avoiding getting carried away by sudden market surges. Got it. What's the next aspect of practicing this discipline?
The report highlights the importance of regularly rebalancing your investment portfolio.
Rebalancing, how does that work?
While over time, the initial allocation of your assets, say 60% stocks, 30% bonds, 10% real estate, might drift away from your intended targets because different investments perform differently.
Mine might shoot up.
Exactly. Rebalancing involves strategically selling some of the assets that have outperformed and become overweight in your portfolio, and reinvesting those proceeds into assets that have underperformed and are now underweight. This brings your portfolio back into its desired balance and effectively manages your overall risk exposure.
It's like tending a garden, I guess, making sure everything is growing in a balanced way. What about the long-term thinking component of this final step?
The report advises focusing on identifying and investing in significant long-term trends, rather than getting too fixated on short-term market noise. This involves carefully considering factors such as technological advancements, evolving demographic shifts like an aging population, and the growth of emerging industries that have the potential to significantly shape the future economy.
So taking a broad view and positioning your investments to potentially benefit from these major enduring shifts, the report also brings up a concept here that's incredibly powerful for long-term growth: the magic of compounding returns.
Yes, absolutely. The report really emphasizes the transformative power of compounding. By systematically reinvesting your investment gains, whether they come from dividends, interest payments, or capital appreciation, just putting them back into your portfolio, you allow your money to grow at an exponential rate over time. The longer your investment horizon, the more significant and impactful the effects of compounding become on your overall returns.
It's like that snowball gathering, more and more snow as it rolls downhill, right? Growing larger and larger over time. And the report circles back yet again to the role of real estate in this final step as well.
It does. It reiterates that strategically incorporating real estate into your long-term investment strategy can provide valuable stability, potentially a consistent stream of cash flow through rental income, and the potential for significant long-term appreciation in property values. It offers another important avenue for wealth accumulation and overall portfolio diversification.
So according to this report, real estate isn't just a maybe short-term play. It's presented as a key component of building lasting long-term wealth. What's the final piece of guidance in step 3?
The report strongly recommends seeking professional advice when you feel it's needed. Look, investing can be complex, right? And consulting with qualified financial advisors, experienced tax professionals, or knowledgeable real estate experts can provide invaluable guidance that is specifically tailored to your individual financial circumstances and your long-term goals.
That's a really important reminder. Don't hesitate to seek expert help when you feel you need it. So just to recap the entire 3-step strategy from the report. It's about building a solid financial foundation first.
Goals, diversification, emergency fund.
Right. Then, diligently identifying undervalued opportunities across various asset classes, including that emphasis on real estate.
The research phase, fundamental analysis, contrarian thinking.
Got it. And finally, consistently practicing discipline and maintaining a long-term perspective, while embracing the power of compounding and seeking professional guidance when appropriate.
Exactly. And the report concludes by reinforcing those initial mistakes to avoid. Steer clear of chasing fleeting trends, always conduct thorough research before investing, and try to keep your emotions in check when making financial decisions. By integrating these preventative measures with that proactive 3-step strategy, the idea is you significantly enhance your potential for achieving your long-term financial objectives.
So to summarize it all for you, the listener, our deep dive into this Warren Buffett Pyramid Report has highlighted the critical importance of avoiding those common pitfalls, like chasing hot trends, neglecting your research, and letting emotions drive your decisions.
Yeah, those are key barriers.
And on the flip side, it's laid out a comprehensive 3-step approach. Build a robust financial base, actively seek out undervalued opportunities in diverse sectors with that strong mention of real estate, and consistently practice discipline while maintaining a long-term focus.
What's truly insightful, I think, is how the report underscores that the potential to double your money within that 5 to 7 year time frame isn't presented as some closely guarded secret, but rather the potential result of consistently applying these fundamental principles.
Right.
It's about embracing a thoughtful, well-researched, and disciplined approach to your own investment journey.
And that brings us toward the conclusion of today's deep dive. You could think of this framework from the Warren Buffett Pyramid Report as maybe a valuable starting point for strategically considering your own path to financial growth.
Yeah, and this raises a really important point for you, the listener, perhaps. As you reflect on your current financial situation and your long-term aspirations, which of these principles truly resonates with you the most? What's maybe one concrete, actionable step you could take, perhaps even today, to begin integrating some of these ideas into your own investment strategy?
That's a fantastic thought to leave you with. Remember, achieving your financial goals is absolutely within reach when you're armed with the right knowledge and, crucially, a proactive mindset. Thanks so much for joining us for this deep dive.